Welcome to Schedule C to S Corporation. I hear from accountants all the time that tell me they have a hard time knowing how to communicate about these types of tax strategies with their clients. For that reason, I'm going to present today's strategy just how I would to my clients to give you some ideas on how you can talk about this. The bottom line is be energetic, be honest, and be excited about the tax savings, and they will be too. But first, a disclaimer. The following presentation includes very generalized information, and choosing an entity for your business and investments are going to require you to make a choice depending on the specific facts of the situation. So it's always recommended that you contact an attorney or a specialist to set up the best structure for the business in question. Do you know which business legal structure you fall under? Do you know the benefits and differences? We see many business owners make the same mistakes over and over when starting a business. They quit their day job before proving the market. They believe that they'll make a great salary or even profit in year one, and often ignore their marketing funnel until it's already too late. But their first mistake is usually ignoring their business legal structure options. In fact, most entrepreneurs tend to select the first option someone else recommends without really understanding the implications. Today, I'm going to highlight the most common business legal structures for small businesses, and I'm going to walk you through how lucrative this choice can be. And I'm going to give you examples of converting from a Schedule C to an S Corp. But first, we need to understand the players. We have Congress. They're the ones who make the rules on how income and taxes work between the other players. The other players are you and your business and the IRS. For your business, there are 5 basic entity structures. As we review these different entities, keep in mind that even if someone initially selects an entity that works, it pays to regularly review the selection, what the current laws are, and what their current circumstances are to ensure that it's sound and still optimal in keeping taxes low. Now, very often the structure of your entity evolves over time as the business develops and grows. The different business entity structures come in a variety of shapes and colors. The one you pick should meet the best combination of factors in meeting the goals for the business and helping to pay the least amount in taxes. Now, there are multiple factors to consider. You want to consider liability protection in addition to saving money on taxes. You want to consider the holding period for the business. How long are they expected to be in business? The type of operation that's being run, where they're getting the money to actually start the company, and who are those partners and investors. Finally, you also want to understand the level of compliance, because what's required for one may not be required for an alternate choice. Let's talk about business liability first. And as you can see, I'm illustrating this fact with the dragon and trying to shield the business from liability. See, the problem is that we face a lot of lawsuits from potential customers or clients, employees, and accidents. When you have no formal entity, it's like no protection, not only for what's in the business itself, but also for what the owner holds personally. On the other hand, protecting yourself with a business entity is like a shield against the dangers of those lawsuits. The next most important factor to discuss is taxes. You want to give the least amount of money possible to the government. That cash belongs in your pockets. Of course, in addition to planning for income taxes, you also need to be aware of other taxes that may apply. For example, self-employment tax on pass-through entity income. In addition to regular income tax, your profit from the business can also be subject to self-employment tax. This applies to LLCs, partnerships, and sole proprietorships, because in these types of entities, you can't receive a W-2 or salary. Let me give you an example of that. You have your personal income, your job, Perhaps you're married and your spouse has income. You may have sold some property during the year and you have income from that as well. Of course, you're going to report your pass-through business income that is there. And you might qualify for a 199A deduction. We talk more about that in another class. Let's say that your qualified business income, for example, is $50,000. We multiply that by our 199A rate, and that gives us a deduction of $10,000. We add up our business and our personal income, and that gives us our adjusted gross income. Now we take away. We subtract our personal deductions, our itemized or a standard deduction, and our 199A deduction of $10,000. That helps us come up with taxable income, which we just multiply by that lower tax rate. The second type of ownership structure are corporations. In a corporation, all profits are taxed from the business directly to the IRS. If any dividends are paid, the individual owner who receives those dividends is going to pay tax as well. It's a concept that we often call double taxation. So they're going to pay some personal taxes on that income as well directly to the IRS. So let's say, for example, you've got a W-2 salary from that corporation and some dividends, which represents the profit that's paid out of that corporation. That's going to help you arrive at your AGI, or your adjusted gross income. Finally, you take out your personal deductions, either standard or itemized. And of course, you arrive at taxable income, which you multiply by the tax rate. Now, many people wonder, why would you ever want a corporation? Number one, it's really good for those who are keeping cash in the business to reinvest and help the business grow. In fact, it's one of the only entities that actually rewards you tax-wise for putting money back in. The second reason is when you have long-term investors or you're looking to take the company public. A C corporation is really the only kind of entity you can do that in. And finally, there's a really juicy benefit for C corporations only. It's known as a 1202 exclusion, where you can sell your company and get up to $10 million in tax-free income on those profits. So there are plenty of reasons why a C corporation might be best. But let's go a little deeper and get the pros and cons of each entity structure. It's really about laying out those benefits and disadvantages and coming up with a process of elimination to determine what is the best fit for the situation. We'll start with sole proprietorship. Sole proprietorships can be good when you're not ready for a business, when you don't want to do this long term, or maybe you're just working on one project. Maybe it's the first month or two of the business life. Now, it can be bad for any situation where you want to grow a business, pay yourself real paychecks, and when you have more than one client. Now, sole proprietors are pretty common when a business is just starting. In fact, many people will tell you to go this route until you prove the business is there. However, a sole proprietorship can easily get you into the most tax trouble if you aren't careful. A sole proprietor is literally just the equivalent of earning income as an individual. You have no business protections, and you by yourself are the business. This can be dangerous, as the IRS also demands that you pay taxes on all income you make. But unlike a paycheck that comes with payroll taxes and a W-2, you typically don't pay those taxes until they appear at year end, which can be an unwelcome surprise to anyone, and an additional tax. Now let's talk about an LLC or partnership. These are good for small ventures, sole proprietors that want some protections, owning equity in other companies, or owning property. Now, it can be bad for a growing business if you want investors, or if you aren't good at bookkeeping and business separation. There's strict requirements on regulations for paperwork. LLCs are used quite often for new small businesses. The legal upkeep is less of a burden, and the cost to start one is lower. and you can be more flexible with money, which can also be a big negative if you aren't careful. Now, many LLC owners get into trouble with the flexibility of the corporate structure, especially if you're the sole owner. We always recommend that you keep separate business bank accounts and pay yourself correctly. That said, you can wait to pay taxes until the end of the year and freely move money between the business and yourself. This can cause issues, though, at tax time, and if there's ever a legal issue with your business, LLCs don't always protect your personal assets in these cases, especially when there's not a clear separation between the business and the owner. LLCs also require that any money you pay yourself be subject to normal payroll taxes. Now, we already talked about a few reasons why a traditional C corporation can be good. It can be good for people who want to grow a business, when you have multiple owners, and for tax savings. But it can be bad if you want the business to hold equity in other businesses, or if you're not committed to the growth. Now let's talk about S corporations. They are a special subset of corporations, and they act as a pass-through entity. They help to avoid that well-known double tax of the C corporation, while also benefiting you from the tax savings that you can get out of passing through your profit. The S corporations, like I said, are a subset of corporations, and so they require a few extra legal steps and a more rigid pay structure for owners that work in the business. But they can also protect you personally. The biggest benefit for the small business owner is that as long as you pay yourself a reasonable salary with associated payroll taxes, you can then pay your profits in the form of a distribution, which saves you payroll taxes because it's not subject to them. This means that the more your business grows, the more money you can save by paying less in self-employment tax and a reasonable salary. This can really add up as the business grows. Now, it's never easy navigating the world of small business legalities. Most entrepreneurs or small business owners make a guess, they follow the flow of a few fellow business owners, or they settle with the first answer that Google gives. But both with a C or an S corporation, it's possible to gain Social Security and Medicare savings because it's only due on the amounts that are paid out as salary to the owners. Now, choosing the wrong entity type can backfire because it may subject you to additional taxes that simply don't need to be paid. Let me give you a simple example illustrating a sole proprietorship or Schedule C and how converting to an S corporation can help save taxes. If you imagine the business being like a vending machine, here I've got an illustration where we've got profits earned in a sole proprietorship versus profits earned in an S corporation. In a sole proprietorship, the vending machine only distributes one type of income, and that income is not only subject to federal income taxes, but also up to 15.3% in additional self-employment taxes. In an S corporation, on the other hand, the vending machine pays out two different kinds of income. Now, of course, you're going to pay Social Security and Medicare tax on the reasonable compensation that's paid through the S Corp. But for everything else that's paid out as a profit distribution, you avoid FICA and self-employment taxes on those earnings. So think about it this way: for every dollar you shift from a Schedule C to split between a reasonable wage and a profit distribution, you're going to reap the savings of up to 15.3%. Now, there are many, many, many more benefits to entity planning, and especially with C corporations, but this can be much more advanced. If you're not careful, you might cost your taxpayer even more tax that's due because of the double tax on a corporation. So make sure that you seek additional education to learn more about how entities can help reduce tax. Now on the screen I've got an example just comparing the tax amounts side by side between what's earned in a Schedule C, for example, versus earning the same amount in an S corporation. Let's say we have a real estate agent's business, for example, and they earn $184,000 in a year. We're going to report that total income on a Schedule C. That's what gets reported. Now, of course, you're going to pay income tax on that amount, but you're also going to be subject to self-employment tax. And in this case, it's $20,000. That leaves you with a net of $164,000. Now, if we compare that to the S corporation, the same $184,000 gets reported. That's what the business earned. But here's where it gets interesting. Let's say that in that particular area, the reasonable compensation for a real estate agent is just $30,000. What we're doing is we're actually splitting that income between a salary of $30,000 and a profit distribution of $154,000. The FICA that's due, $4,590, is what's owed on the salary only, and that leaves us with a net of $179,410. So in this particular case, the S corporation saves $15,410 per year. Now, another way of looking at this is saying that the sole proprietorship cost the taxpayer $15,410 additional in tax every year. I mentioned there's other qualifying C corporation benefits that you definitely want to be aware of, but again, it can get more complicated, so make sure you're educated on how to use that. One word about property ownership. There are special circumstances you should consider when holding real property inside of an entity. If you're buying and holding to rent out that property, then an LLC is probably going to be ideal because rentals in LLCs get many tax benefits and tend to be cheaper and easier to run than, say, an LLP. Now, if we compare that to a flipping business, a real estate flipper that buys property and makes an improvement, a flipper's going to want to consider the tax implications and whether it's best to be taxed as a disregarded entity or as an S corporation. That's because there's self-employment tax involved. And finally, for those that are wholesalers and in the real estate business, either an LLC taxed as an S corporation or an S corporation itself will be the best entity choice. Now let's say your property management company, either an LLC taxed as an S corporation or an S or C corporation could be the best choice. Again, the idea is to lay out all the benefits and the disadvantages and slowly remove the options as you narrow down your choice and through a process of elimination end up at the ideal solution. As you can see, the tax savings can be massive just by making small shifts in your entity selection. Now, if you're looking to learn more about entity selection and grow your knowledge, check out the website on the next slide. And I hope this gives you ideas of how to have these conversations with your clients, whether you describe liabilities as a dragon like I did, or some other convenient way to help them learn. It's all about speaking in a language that they can understand so that they can get excited about tax planning.